Good morning, or good afternoon, or good evening. My name is Scott Kennedy. I'm the Trustee Chair in Chinese Business and Economics at the Center for Strategic and International Studies in Washington, D.C. And I am absolutely delighted to be able to host and moderate this discussion today where we are rolling out our new report, Red Ink, Estimating Chinese Industrial Policy Spending in Comparative Perspective. We've been working on this report for quite a bit of time, almost a year altogether, with a very large team. And I'm here today with my co-authors for the report, Ilaria Mazzocco and Gerard DiPippo, as well as several experts who have been working on industrial policy from many perspectives for quite a long time. I also want to give a shout out to Matt Goodman, who with me also was editor for the project as well. And we issued the report yesterday, and we are going to discuss it today. And from basically three kinds of questions that we're going to tackle today. First is the basic question of how much is China and other countries spending on industrial policy? And that is really the core of the report. And it was just surprised us that that question had never been answered before. And we've tried to come up with our answer. And we're going to hear from my co-authors and the commentators about that answer. But we're also going to try and dig into two other questions as what's it mean? What is the significance of the data on industrial policy spending? What are its implications? The last question is, what should we do about it? What should governments in the United States, around the world, international institutions, now that we know what the data says and we have a sense of what it means, what should governments do about it? And so we're going to try and grapple with all three of those today. This report is not the last word by any means in this conversation, but we do think it marks a turning point in the conversation because we put together this overall estimate, which has not been done before. I'm going to turn to our commentators in a little while, and at that point, I will appropriately introduce Jahan, Réka, and Yaoyang to everybody. But I'm going to turn first to my co-authors, Ilaria Mazzocco and Gerard DiPippo, to give an overview of the report's findings itself. But let me first say a little bit about both of them because it's just been an honor to work with them on this report and to suffer through all of the challenges together. If you're going to suffer with folks in the data bunker, I'd like to do it with them. So Ilaria Mazzocco is a fellow with the Trustee Chair in Chinese Business and Economics here at CSIS. And prior to joining us a year ago, she was a senior research associate at the Paulson Institute, where she led their research on climate change and energy policy for Macro Polo, the Paulson Institute's think tank. She has a PhD from CSIS and spent a long time doing fieldwork in China, looking at clean energy issues, electric vehicles. And she's going to keep doing that here at CSIS. Gerard DiPippo is a senior fellow with the Economics Program here at CSIS. He joined CSIS after nearly 11 years in the U.S. intelligence community. From 2018 to 2021, he was Deputy National Intelligence Officer for Economic Issues at the National Intelligence Council, where he led the IC's economic analysis of East Asia. So they are both super qualified to have taken on this task and led our team of researchers in putting this all together. So let me turn things over to Ilaria and Gerard for an overview of the report, and then we will turn after them to our commentators for a discussion of what it all means. Ilaria and Gerard?
Thank you, Scott, and thank you everyone who's tuned in to listen. I'm very excited to present this work. It's been many months in the making, so I'll get right to it. So the key findings are that we found that Chinese industrial policy is really large by any standard you look at it. So if you look at it from a GDP, the share of GDP, it's 1.73% in 2019. If you look at it from a dollar market rate, that's 248 billion. And by comparison, to put that into perspective, the think tank CPRI estimates that China's total defense spending in 2019 was 240 billion. So that tells you something. From at purchasing power parity exchange rates, it's $406 billion. When you compare that with other countries, it's clear that from whether you're looking at percentage of GDP or dollars, it's still far larger than any other country. And Gerard will get a little more into the details of what that means and what that looks like. We then did we looked at micro level studies and looked specifically at sort of specific sectors to try and see how this matched up. And we found that there are some industrial policy tools which we were not able to include in our estimates. They are very important, especially in China. And so this tells us that the estimates are really conservative, especially for China. And we'll get into what industrial policy tools we were not able to include, but that's also because there were significant limitations in the data available. So taking a step back, what was the goal of this project? And Scott sort of hinted to this already. There's a lot of research on the effectiveness or impact of industrial policy, which of course is very important for policymakers, but there's very little on the size. And we felt that it was really important to have numbers to look at numbers when evaluating industrial policy. So that was our goal, was to actually find a number. And we found that there was very little that had been done on this, especially when it came to China. So the key goals were to, one, quantify China's industrial policy spending, two, compare it to industrial policy spending of other major economies, which meant calculating industrial policy spending for those other economies, and then identifying gaps and limitations, which, as I mentioned, were actually quite important and significant and really hindered, I think, some of the quantification process. So what else we include is that identification of those areas that are non-quantifiable in Chinese industrial policy. Then a historical comparison, because of course, different levels of development have been correlated with different levels of state involvement in the economy. And then sectoral state case studies, which, as I mentioned, are really important to put into context and really understand what tools are important and how they are used, and sort of checking whether our macro level estimates kind of match the micro ones. So the first step in operationalizing this was actually defining industrial policy. There is no clear there's no one definition of industrial policy, which is somewhat surprising given that everybody's talking about it these days, right? There's very broad definitions, there are very narrow definitions. We tried to find something that is relatively broad, but that does not include everything, and try to somewhat limit the level of horizontal policy included in our estimate. So we define industrial policy as any state intervention, explicit or implicit, that aims to reallocate resources to support certain firms or sectors to achieve one or more policy objectives. So this means we do include multiple types of motivations and types of instruments. And we'll get into exactly what that is. So when we want to operationalize this, we actually took a step back and looked at exactly how the state can support, what types of industrial policy are there. So there's direct subsidies, and then we went and looked for exactly how to estimate those for each of the economy in our sample. We did the same for tax incentives, specifically targeting R&D, and we relied actually heavily on the OECD database for this, but not only. Similarly for government support for R&D, and here I should note it's government support for R&D conducted by firms. We're not looking at R&D as a whole, university funding, that sort of thing. Other types of tax incentives, for example, something that might be a targeted types of taxes, energy subsidies for manufacturing, that sort of thing. Below market credit, which turns out is extremely important in China. and the state investment funds. So an example of that is the government guidance funds, but there are other examples in other countries as well of state equity investments in domestic firms. And then we found several China-specific factors for which we struggled to find an equivalent in other countries. So the most important one of those, I would say, is below market land sales, which it really is derives from the fact that land is publicly owned in China, so that the state owns all land. SOE net payables. Gerard will get into these more in detail, but it's that refers to the practice of SOEs delaying their payment to suppliers, and that equity swaps, which was also a program introduced in China to help reduce the level of debt in firms. What this means in practice is that we included and excluded specific types of categories. So we did include corporate R&D subsidies and tax incentives. We do know that some of these are horizontal, and as I mentioned, we really tried to avoid horizontal policies and focus on the vertical ones that really target specific industries and specific firms. But we felt that R&D subsidies and tax incentives are really important in a lot of the countries, and we'd be missing a big part of the story if we didn't include them. We did exclude regional development programs. These often focus on reallocating resources internally, and they, I think if you look at the specific regional programs that these economies have, they look very different from the types of industrial policy that we were interested in capturing. Same goes for agricultural and energy subsidies. A lot of these just aren't as relevant to industrial policy. We did include, though, as I mentioned before, energy subsidies that go to specific firms or industries. So there's a few cases of that in some of the countries that we looked at. We excluded government procurement due to data limitations. We would have liked to include this since we think this is a really important policy tool. And here, by this, we mean targeted government procurement and the benefit, the real subsidy comes to firms through that. And we were just simply unable to find any data that could help us to calculate that. We also excluded small and medium enterprise programs. As again, we were trying to exclude broad horizontal policies and credit guarantees and insurance, which are really important for export support. We also excluded because, again, it was very difficult for us to think of a way of calculating the actual subsidy part of this. But we recognize that this may be something that we're not capturing. So having said that, I'm going to pass it on to Gerard, who can walk us through the charts.
Thank you. Hello, everybody. Now is the time you've been waiting for, the charts. So this first chart, we plotted our estimate of Chinese industrial policy spending through 3 years, so 2017 through 2019. This is as a share of China's GDP in those respective years. What will probably jump out to you is that the total level doesn't change very much. Most of the variance is actually in the below market land sales. Those fluctuate in part with demand, in part just with prices. But in general, if you look at the other stacks in the bar chart, you'll see that they're actually pretty steady as a share of GDP. Our report talks in great detail, actually, about the methodology we use to calculate these things and how it's different with the other economies in our sample. In many cases, we had to use different methodology for China because of data limitations. I will not go through all of that right now, but I want to highlight a few things here that I think are worth flagging. Moving from the bottom of the stack, so direct subsidies. In the case of China, what we're doing here is looking at listed firm data, so Chinese firms that are listed on stock exchanges, which report subsidies in their filings, total subsidies. We are then able to estimate how much is going to unlisted state-owned enterprises because China also reports basically the full balance sheet of SOEs, so you can do some ratios there. We do not do an equivalent estimate for unlisted private firms in China because there's no similar national data sheet of private firms in China. And that's important to mention because that yellowish orange direct subsidies bar at the bottom, that's understated. The true level of subsidies going to private firms is certainly higher. We don't know how much higher, but it is higher. Another thing to flag is the tax incentives in the case of China are also based on listed firm data. It's technically tax rebates and fee rebates. Another thing that we need to flag is that China, for below market credit, in the case of China, we estimated that by essentially taking the spread, the borrowing advantage that state-owned enterprises have over private firms in China, looking at both bonds and loans. This is different than how we do it in other economies because Because in the case of China, it's true that they have, there's China Development Bank, there are policy banks, but China Development Bank actually mostly lends for infrastructure projects, which we are not counting. We don't count infrastructure as industrial policy, even though some very broad definitions might. Instead, we know that in the case of China, most state-affiliated credit for policy goals actually go through the commercial banking sector. So as a proxy for that, since they don't Chinese banks don't say this much is for industrial policy, but you can estimate how much is going to state-owned enterprises. That is not a perfect proxy because not all SOE use in China is for industrial policy, but it is part of Chinese political economy, and it's a very important part of China's overall toolkit. The other thing to flag above that would be state-owned investment funds, which we could talk about more if you like. But in the case of China, what we're talking about here are government guidance funds. We're basically taking a spread that we apply uniformly across all the economies for the various equity funds that governments own. So basically, it's estimating the investments made each year and then taking a spread of that to estimate the premium that companies are getting. In other words, sort of the above market price that they're getting from those types of interventions. And then the three special ones to China in our stack are below market land sales, SOE net payables, and debt equity swaps. The most important, as Ilaria already says, is below market land sales. That's the one that fluctuates the most. There actually is IMF data going back to roughly year 2000. It's in like 4 or 5 year increments, but what that shows is that implicit subsidy has waned over time in importance. So 20 years ago, it was very important for localities to use in-kind transfers to support enterprises. Now that is much less important. So that is probably falling over time. The SOE net payables, a little bit technical, but as Laura said, that's basically SOE's ability to withhold payment. We'd use a proxy where it's essentially looking at their estimated net payables multiplied by the same credit spread. In other words, what it's saying is if they had borrowed to essentially have those implicit loans, this is how we would compare to the below market credit part of that stack. And then finally, there's debt equity swaps, which are frankly almost too small to see. These actually kind of petered out around 2019, so they're probably not all that relevant right now. We thought they were worth including. Next slide. So now we're getting to the comparative charts. So one thing that will jump out at you immediately is that China's spending as a share of GDP is much higher than any of the other economies in our sample. And we should say that those are the ones listed. So that's South Korea, France, Japan, Germany, Taiwan, United States, and Brazil. So 7 other economies. We present China in 2 different ways. On the far left is with those 3 China-specific factors that I just mentioned. And then the second from the left is just the comparative version. So if you strip those 3 things out, in both cases, what you'll see is that China's spending is multiples higher of everyone else as a share of GDP. Even if you go even more conservative, and let's just look at direct subsidies, that's the bottom bar. Even then, China is 3, 4, 5 times the size of what other countries are spending on those direct subsidies to firms. So no matter how you split it, China spends way more than these economies on its industrial policy. I should also flag 2 other things. One, we use 2019 as our base year. Part of that is because of data limitations. Even 2020 data is not always available for some of these series, but the real reason is that 2020 is the COVID year, and the pandemic year is just a terrible year to baseline anything because of the way governments had to respond so massively. It really distorted fiscal data and economic data. So we thought that 2019 is a much more reasonable sort of pre-shock way of baselining. And the other thing to flag is that while South Korea is noticeably higher than the other economies in our sample were all kind of in a tight range. It's roughly 0.4, 0.5% of GDP. We're not expecting it to be that uniform, but it's something that shows up in the data. And there's sort of this implicit cap there of how much governments are spending on these things. But you also notice the allocation of those tools differs. So, for example, France spends a lot on R&D tax incentives, whereas, say, Japan uses more below market credit. There's different varieties in political economy and tools there. Next slide. So this is looking at the same data, but it is putting it in market exchange rates, so in dollars for 2019. Again, you'll see that China is much higher. So the higher end estimate is $248 billion at market exchange rates for China. We note repeatedly throughout the report, and we'll even note it on this chart, even that high end estimate should be treated as an actual low end estimate because there are other factors that we know are not being quantified that we know that are quite important for China and others, but there are also special things that there's just no data for us to tabulate to get that estimate. So really treat this as a low end estimate. The United States is second. That's really a function of the United States being the largest economy. So it's at $84 billion. And then you have essentially everyone else is much lower. You get, below $10 billion with Brazil and Taiwan. Next slide. So again, same data, except we're doing this at purchasing power parity exchange rates. You could debate which method is better. PPP is capturing differences in costs across these economies. And since most of the spending is going to be domestic, in a sense, this probably is a better metric of sort of how much benefit those firms are getting within their own economies. And again, and actually even more so because of China's PPP exchange rate, which is stronger than its market exchange rate. The Chinese level is just much, much larger. The United States is the same, and everyone else is, this distant third tier. This is, so in chapter 4, we talk about, it's a comparative study of the evolution of industrial policy across the 8 economies in our study. I highly recommend reading it. Park, it's actually a handy reference. It's just a good sort of quick history of what happened in those 8 economies. A few things to flag here. It is difficult to get data for recent industrial policy spending for many economies. It's even much harder to get it for historical data series. There are cases like, say, the United States, you might be able to have, historical R&D spending. But in general, it's very hard to get data on, say, peak industrial policy in Korea in the 1970s. So this is more of a qualitative assessment. And what you find in that assessment is that across these economies and others, peak vertical industrial policy was most pronounced before the 1980s. So 1960s, 1970s were sort of peak import substitution strategy in some other economies. In the 1980s and 90s, this is the so-called Washington Consensus years. There was a general turn away from industrial policy across pretty much all these economies, except China, because it was still very much a developing country at the time. And then, sorry, there's a fire engine. Since the 2000s, many governments have been focused more on what is really innovation policy, but it relates to industrial policy. So a great emphasis on R&D, small, medium enterprises. In recent years, this might be changing, in part because of competition with China. When you look at the case of China's trajectory, there are 3 things that make it a real outlier. First is that it's increasing its vertical policy, so policies to support specific firms or industries at a level of development when its East Asian peers dialed them back. So comparing it to, say, South Korea, Japan, and Taiwan in our sample, at comparable levels of, say, per capita GDP, they were sort of already at peak industrial policy and were waning that support. China is also targeting advanced technologies at the frontier of innovation. The sort of classic case for industrial policy is more for catch-up, so it's allowing developing economies to move closer to the frontier so they can compete with the advanced economies. China is still pursuing these tools when it's already or nearly at the innovation frontier, which makes it a bit unique. And finally, if someone said, what is the one factor in the sort of Chinese political economy or toolkit that makes it special? I would say it's the state ownership of the financial sector. That's a really key difference because it allows the Chinese government and localities to allocate financial resources in a way that other economies, at least in our sample, cannot duplicate. And an example of that would be the government guidance funds.
So I'll take over from here. Thank you, Gerard. So just very quickly, I already mentioned the importance of sectoral case studies and why we looked at them. So what we did was we picked 3 different sectors: aluminum, semiconductors, and electric vehicles. And then we looked at research and compiled and looked at, carefully at what research had been done there and what the data there tells us. And what we found, and we're lucky to have here one of the co-authors of some of the OECD reports that we relied heavily on, that were excellent in their research. And what we found was that in all of them, we find that below market credit, below market equity are really important. And this really reflects, I should note that this is for Chinese firms really benefit from below market credit and below market equity, disproportionately so compared to other firms within these sectors. And this is really reflective of what we found at the macro level. In addition to that, we find measures, for example, trade measures in the aluminum supply chain to benefit Chinese manufacturers. government guidance, which is sort of a political signaling of the priority of certain industries. Targeted public procurement, really important. We find all those tools we were not able to include in our estimate. So that all suggests that there's much more to industrial policy than just what we were able to quantify. So this is, suggests that, as we mentioned before, our estimate is conservative. So moving on to what, here we go, policy implications. I think we were constrained in some ways by what is actually realistic. Right. I think we can have very broad targets, and there's many implications, and I'm looking forward to a discussion on that. But some of the more specific actionable items we felt were related to a better disclosure of data and more transparency. So we have a list here, which I won't go through every detail, but I just want to point out that there's quite a bit of inconsistency even among developed countries that are part of the OECD, or so they're somewhat like-minded in many ways. And some of the standardized reporting would actually be relatively easy to fix in some ways. But there's also just lack of reporting of certain types of data, for example, government procurement data, and subnational data, very challenging. So these are just some ideas for places to start that would actually really help move forward the conversation and really improve transparency. And having said that, I think we've reached our time. So I'll hand back the word to Scott.
Well, thank you so much, Ilaria and Gerard, for going through that. I'm going to use the host prerogative to ask you both one follow-up question, and then we will turn to our panelists. So, and we do have a couple extra minutes. You guys were efficient. I think more efficient than most countries' industrial policy spending. So I'm going to ask you, and I know that this is going to be uncomfortable, to step away a little bit from the data, from the hard numbers that you have. And I really am glad that in the report, we did not go beyond what the data could let us say. But I'm going to ask you to just speculate a little bit on the historical question. You provided a little bit of historical context just a minute ago, and I encourage everyone to go look at the report in more detail. But let me just sort of ask you to sort of at a bottom line conclusion on history and the Chinese case, and we'll get to the other cases in a little bit. But just on the Chinese case, let's say we were doing this study in 2000, the year before China joined the WTO, and you didn't have any of the data problems that you said were impossible the further back you go. Can you speculate on two things? One, what would the shape of the stack, that 9-layered cake, have looked like in 2000 in a way that's different than the way it looks like now? You hinted at a couple things, but I want to know if, what you think that stack might have looked like. And the second is, do you think that stack would have overall been higher, the same size, or lower? That's as precise as I need you to be. Just as a percent, obviously, in terms of absolute dollar values, it'd have been a lot lower because China's economy has increased like fourfold at least since it joined the WTO, if not more. So we'd obviously have an absolute number that would be smaller. But as a percentage of GDP, do you think industrial policy spending over the last 2 decades is less than it was 2 decades ago, the same as it was 2 decades ago, or more than it was 2 decades ago? So just trying to get a hone in on sort of the historical takeaways, even though it requires you to go a little bit beyond the hard data that we've collected for the report.
I'll take an attempt at that. So that's a great question. I think that the biggest difference would be that 20 years ago, the Chinese government, both the central government and localities, had much lower fiscal capacity. So you see this with their ability just to collect taxes as a share of GDP. If you looked at the stack in the year 2000, one, in general, the Chinese economy would have been much more dominated by state-owned enterprises. They would have been in the middle of massive layoffs at the time, but it still would have been much more SOE dominated. I believe the part of the stack that is below market credit going to SOEs would be a much larger share. In fact, there's a reason why the Chinese banking sector had a banking crisis about 2 years earlier than that, because they had so many bad SOE debts. There would be no government guidance funds. There might be some limited equity funds, but in general, the sort of more marketized, market-oriented approach of recent years would not have existed. It would have been much more, in-kind transfers, explicit subsidies, and just general credit. As I mentioned before, I think the land subsidies would have been a larger share of the stack, and in fact, there is IMF data on that suggests that's the case. And what we're calling direct subsidies, I suspect would be smaller. The listed firm data definitely suggests that has increased over time as a share of GDP. Part of that is that a larger share of Chinese companies are listed now than 20 years ago. But I think basically it's been more over the last 20 years. It's been more formalized, and in the past 5 or so years, more of an attempt to make it market oriented as opposed to rely on a classic like state-owned credit model of the planned economy. If you're talking like the actual level, the share of GDP, I don't know. I suspect it was probably bigger back then, mostly because the economy was so much smaller, actually. But I think the big difference would be the sort of the attempted market orientation of recent years.
Super, thank you. Ilaria, you want to add to that?
No, I actually think Gerard covered most of it, but I would agree. I think what I like to think of it as it's market tools. It's not necessarily using market forces, but it's market tools like the equity, state equity funds and that sort of thing, right? We see that a lot more of that.
Yes. I guess if I was going to put a guess in for this and suggest why it might be higher now, the reason I might think of, and we can get to the panel on this and come back to it, is just some of the things that they're trying to do are just more expensive. Supporting the semiconductor industry or electric vehicles or global positioning systems or things like that. Those are more expensive than trying to get your auto sector started. And so it may be that the economy has grown so much that those still as a percentage of GDP are relatively smaller, but just the price tag on some of these things seems to be pretty high. So but anyway, I'm glad. I just wanted to put that on the table. I think what we're trying to do is come up with a list of topics for other folks to work on once they've digested our study. And we've got 3 people with us who have done work on industrial policy from a variety of perspectives, and I want to turn to them now to get them to comment on our study and the broader questions that it raises. Jehan Sauvage is currently policy analyst in the Trade and Agricultural Directorate of the OECD, where he specializes in questions related to market distortions and government subsidies in industrial sectors. Prior to this position, he also served as counselor in the office of the OECD's Director for Trade and Agriculture and as a policy analyst in the OECD's Trade and Environment team. Réka Juhász is an assistant professor of economics at Columbia University. Her work focuses on understanding how trade and technology interact to shape economic development. Her work has shown empirical evidence for the infant industry argument, which is often invoked as a justification for industrial policy in developing countries. And Yao Yang is the dean and professor at the National School of Development at Peking University. He's the Chung Kong Scholar and Boya Chair Professor at the China Center for Economic Research and the National School of Development. He currently serves as director of CCER, the executive dean of ISCAD, and the editor of CCER's house journal, China Economic Quarterly. And his research interests include economic transitions and development in China. We are delighted to have this star-studded panel with us today to talk about the issues in our report. And I want to start with a couple questions to the 3 of you, and I'm happy to have you all begin, at least in the order that I introduced you. And that first question is just if you could just look at the core issue of our report, calculating the amount of industrial policy spending for China in these 7 economies, what most jumps out at you as the contribution from our report? Or maybe you think we've made a bunch of mistakes and that's what you want to highlight, which would be fine. But how would you evaluate the report's methodological approach that we've tried, which is somewhat different from how others have, although we've borrowed from you all and others. So let me turn to Jahan, Réka, and then Yaoyang in that order for your reactions to the report from a methodological perspective.
So I guess I start. Hello, Scott. Hello, everyone. Thank you for having me today. Very happy to be participating in this panel. About your first question, first I'd like to praise your efforts and that of the team towards increasing transparency on this topic, because as you rightly pointed out in the presentation earlier, we have found the same thing as you did, meaning there's not a whole lot of research trying to come up with a total number for all this. Even like numbers at sector level are really hard to come by. And so any additional transparency is greatly appreciated. And I know how much of an effort that is. As a matter of fact, I was involved recently in a joint report that the OECD did with the IMF, the World Bank, and the WTO on the question of subsidies in general, so writ large. And one of the main findings of the report is that we don't know a whole lot of, we don't know a great deal about the scale of subsidies, particularly in manufacturing and services, as opposed to agriculture and energy. So first, kudos to the team. And when it comes to questions of methodology and the contribution of the report, the first thing that really struck me is how using different methods as we did at OECD. So you understand you use the top-down method, trying to come up with aggregate numbers, big headline numbers covering the whole of these economies. What we did at OECD was really different, starting from the macro level, at firm level, and building up a picture bottom up. And using these two different approaches, it's striking how we arrive at the same qualitative conclusions. One thing you pointed out is how, for example, direct subsidies and below market credit are the dominant features in China. That's exactly what we found ourselves. But when you look at other economies and the OECD ones especially, it's more like tax breaks for R&D and other tax incentives that jump out. That's exactly what we found. So I'm really comforted in a way to see that we both arrive at the same qualitative conclusions coming from very different angles. And I would say you're very brave to try to come up with a big aggregate number. So again, congratulations and very interesting work.
Sorry, I was off. I was muted. This is life's challenge these years. Réka?
Okay, so thank you so much for inviting me to participate in this discussion. I really enjoyed reading this report, and I'm going to echo a lot of what Jahan said. I think, as Ilaria and Gerard also pointed out, when you look at the literature, it's not that we don't have numbers for the magnitude of Chinese industrial policy today. It's that we don't have numbers for China, we don't have numbers for other economies, and we don't have numbers historically. So I really see this report as breaking a lot of new ground, using realistic assumptions and the best available data. And sort of trying to contextualize the findings, one thing I was thinking about, and this is my first comment, is how do we sort of, if I take a step back and think about what I would want to learn if I was unconstrained by reality in terms of what is available, what I can estimate. Really, I think the deep question that this report is trying to get at is to quantify the extent to which firms and sectors in the economies studied are getting an advantage when they receive industrial policy, when the state intervenes for industrial policy purposes. So we want to quantify by how much do these firms enjoy an advantage vis-a-vis their foreign competitors. That is going to be really difficult to do. It's actually infeasible with the data and the time that is realistically available. And so I think the approach that this report takes is the extremely sort of reasonable approach to basically count the money. So we're going to count dollars spent, and that is how we're going to try to understand the magnitude of industrial policy. The assumption here is that the more I spend as the state, the bigger advantage my firms enjoy. And I think that is, that's a reasonable assumption. But of course, as was also mentioned in the report and in the presentation today, that is going to miss some tools that don't cost the government money, for example, but have massive implications for how level the playing field is. So I think for me, that's kind of the context of how to think about these numbers. The second comment I have is that, which is a little bit in the weeds, but I do think I found it important for kind of thinking about how to compare the numbers across China and the other economies, is that I was personally, 99% on board with all the methodological and sort of educated guesses that the authors were making. The one aspect of the Chinese stack that I would sort of color a little bit is that, the blanket inclusion of the below market credits and the subsidies for state-owned enterprises as a whole, that is plausibly, to my mind, the only sort of way in which it's not a conservative estimate for China, because that is as the report sort of points out, that's really sort of creating a little bit of tension with your own definition of industrial policy, in the sense that this is not sectorally targeted. So that is one that was sort of the only wrinkle that I would put on where I would maybe think about some uncertainty as that number being smaller. And this is important because that's like a quarter of the Chinese industrial policy spending that you get. But overall, I think, thank you so much for producing these numbers. I think this is grounding this very hotly contested sort of question with some facts to actually sort of, bring the discussion to some version of reality.
Well, thank you. I appreciate that. We all do. I think there is a big challenge over the precision versus reasonableness, and we try to do both, but sometimes you have to make some difficult choices. And we can come back to the question about SOEs in a little bit, but it's worth. I appreciate you bringing that up. Yao Yang.
Yes. Great. First, I want to congratulate the team. This is a great report because this is the first time to quantify China's industrial policy and also puts China in international comparison. So, when we talk about the industrial policy, we always think about the specific sectors. That's going to be very difficult for us to do international comparison. And also, we are not able to come up with idea about how big industrial policy in a specific country. We know that China conducts a lot of industrial policy, but we really don't know the size of it. So this time, it's a great report. I would actually love to see a Chinese think tank to do this, but say SIS did it. So that's a great contribution, I think. Methodology-wise, I believe it's quite solid, right? So it just puts all the supports in just one metric. That's money. That's very difficult. But the team spent huge amount of time trying to get the data and finally come up with those numbers. So that's great. If I may to point out some potential drawbacks, I have to say two things. One is to echo Réka's comments about SOE credit subsidies to SOEs. We know that, of course, there is a kind of a SOE bias in China's financial sector, no doubt about it. But there is also another dimension of this issue, that is SOEs in purely economic terms are more trustable, right? So they pay back debts more regularly than particularly those small private companies, right? So there is a kind of a size advantage on the size of SOEs, okay? So they get lower interest rates, then there is some economic rationale over there. As Réka pointed out, that's a huge, that's 1/4 of the total amount of subsidies. So this is one. The second one is SOE payables and debt equity swaps. Payables, as I understand, should be paid back on some day, future someday, right? So this is just a temporary. I don't have exact data, but I thought many private companies also have a huge amount of payables. So in China, the so-called triangle debts are a huge problem. Okay, so I don't know if it's good to just single out SOE payables. That for equity swaps, this is a way for China to restructure SOEs. I mean, particularly for those SOEs that are going to go bankruptcy, right? So it's very difficult for them to repay the debts. So the government convert that into equity, and those equity is sold out in the open market. So this is a purely market-based way to restructure SOEs. I'm not sure if you should include this in subsidies. But of course, the SOE payables and the debt equity swaps are relatively small in the total amount. It's not going to change the magnitude. Okay, let me stop here.
Terrific. Thank you, all three of you. Let me just see if Ilaria and Gerard want to provide a little bit of feedback on some of the issues that you all brought up on methodology regarding SOEs in particular, or if anything else that they picked up they want to respond to.
Sure. So on SOEs, I take your point. We basically admit as much in the report. In the ideal world, we would have data on essentially, sectoral policy-oriented lending of all Chinese banks, and you could sort of aggregate and then see what the below market credit spread on that might be. As I mentioned before, the issue with China, or an issue in this case, is that whereas, say, for Germany, you can look at KfW, their policy bank, and say, okay, that's the one that's making any industrial loans, or say the Brazilian Development Bank, which reports industrial loans. Those are policy bank loans that are used for policy objectives. In China's case, the state owns almost the entire financial sector, and so and there's plenty of evidence that those sort of preferential and policy oriented lending policies are go through the commercial banking sector. So you just can't duplicate the method. So, I agree with the points that like SOEs are not a perfect proxy for industrial policy. And in fact, what they're missing is that we know there are large private national champions in China, particularly over the past decade or so. And this is especially true in the tech sector. And so just focusing on SOEs does miss that. But we also think that it's clear that SOEs are a major part of China's industrial policy, and in general, part of their overall economic policy, including macroeconomic stabilization efforts. So it's, we'd say it's a second best option, point taken, but it's all the data we have. On the net payables point, the thing to observe about the SOE net payables issue in China is that the Chinese government has officially acknowledged this is a problem. Li Keqiang has made multiple statements about it, that there is an observed trend that when there is an economic downturn, those net payable balances increase. Professor Yao is right that in general, companies do maintain net payables, but you see them spike in the case of SOEs in China, and they essentially squeeze private firms. So I think there is sort of acknowledged political economy factor there that is an implicit subsidy for SOEs. And again, what we're doing with that is we're not counting like literally the whole value of the payables. We're taking the same implied credit spread. It's essentially like if they had borrowed that debt instead of imposing it on private firms, what would that spread be? That's why the numbers are fairly small. And on the debt equity swaps, I would just say that, Professor Yao was right that they were intended to be market oriented. I think part of why they seem to have fizzled out in 2019 is that banks were just not that interested in using them, and the overall scale of their use was actually quite small relative to the debt issue in China. But it was clearly designed to solve a specific problem for SOEs in particular in China. And through using a similar, spread method for that, we thought they were worth including. But either way, as you can see in our stack, the debt equity swaps actually don't contribute much to the overall estimate.
Well, let me just chime in. I would just say on the SOEs, and I totally understand Yao Yang's point that since SOEs do generally pay back their loans and are seen as reliable, the lower interest rate that they pay doesn't necessarily imply a subsidy, but that SOEs tend to be much less productive and then private companies suggest that they probably are getting a level of credit that they wouldn't otherwise deserve if they just walked into a bank with an idea and the bank was looking at whether this was a good idea and comparing a private and state-owned enterprise. They are getting, and so it might not actually be the difference in the interest rate that is what SOEs benefit, but just the fact that they get the loans in the first place and other types of companies don't. And so we've just used the credit spread, the difference in benefit, as a proxy, but it's really trying to capture what is the industrial policy advantage that is going on here. I think is again, we're all challenged in figuring that out. And we've just tried one version here. Let's go on to the next question, and we'll start with Réka and then Yao Yang and then Jehan on what this means. So the reason that that Washington, D.C. is focused on this is the idea that extensive spending on industrial policy may confer an unfair advantage to countries and their firms, particularly the larger those countries are and the more they are integrated into the global economy. So there's great concern that Chinese industrial policy spending is a sign of that China may be not just spending a lot on industries that affects its own economy and its efficiency, but affecting others, and may be a sign that China's a non-market economy and that it's operating in ways that are distinctive. And we do show, at least from a quantitative perspective in the comparison, that the Chinese case is an outlier. So that's just one interpretation that helped initiate our paying attention to this and why the policy community is. But it doesn't have to be the only way that folks look at this question of explaining the significance of industrial policy spending and what we should take away from it. Let me start with Réka and get your views, and then go to Yao Yang and Jehan.
Yeah, so I think that's a great question. My sort of take on looking at these numbers is that clearly China, the numbers speak for themselves. Clearly, China is spending the most, and it's outspending both as a share of GDP and sort of in dollar terms the six comparison economies. But I would think of this as a difference in degree and not necessarily a difference in kind. So if you drop me from outer space today and the only thing I knew about these 7 countries were the 7 numbers in this report, I wouldn't look at those numbers and say, oh my goodness, China is doing something that is completely different to what is happening in these other countries. I think the striking thing to my mind is actually something that Gerard pointed out partially in the presentation, which is when you look at these 7 countries together, they're all doing significant amounts of industrial policy. So for no economy are we finding that there's just a trivial share of industrial policy. The reality on the ground seems to be that at least for these 7 major economies, we do see substantial spending on things that we think are industrial policy. The second sort of quick comment that I just want to point out is, one way to interpret China's higher numbers is that it's a country that is at an earlier stage of development than most of the peers in the comparison group. And so typically, I think this was also mentioned during the presentation, typically we think that the state has a larger role to play at earlier stages of development, and one sort of policy tool in the state toolkit has historically been industrial policy. So for me, the bottom line is actually that the reality on the ground is that there's a lot of industrial policy everywhere. I think it would be surprising to not find China doing a lot of industrial policy, but I think of that as differences in degree and not necessarily differences in kind.
Thanks. Yaoyang, is that how you interpret the significance of the numbers?
Yeah, I totally agree with Réka, but I also want to add kind of a more China-specific aspect to this. So in China, the government really has a bias against the consumption and has a favor toward the production. I mean, we can look at the report from another angle. All the governments give the society a lot of subsidies, through the pandemic. Western countries, particularly those rich countries, spend a huge amount of money on people, right, to subsidize directly to people. Okay, China's government doesn't want to do that. Although I have been saying this for 2 years, I said, the Chinese government should give ordinary people cash. Right? It's very difficult to sell this idea to government officials because most of them would think, oh, no, this is just a wasteful. Right? If we want to subsidize the society, we should give money to companies. So we give a lot of subsidies to companies. For example, this year, the government provides a tax cut of 2.5 trillion RMB. That's 12.5% of last year's government income. Huge, right? So this is kind of a different mindset in China. That's also why I welcome this report. It's just ringing the bell. Right? Look at this. Probably the Chinese government has subsidized the industry too much. And we know that many of those subsidy programs have just wasted their money. We should definitely cut some of the subsidies. Okay.
Jahan, your take?
Very interesting discussion. There are two questions, I guess, that come to my mind looking at these numbers. The first is how much of this stack is good versus bad subsidies, and then we're talking about good and bad for who and for what. As for the first, I mean, I don't have a precise answer, of course, but it's presumably some of the support for R&D might be judged desirable for many reasons, including market failures and so on. The same with some amount of support that, I don't know, might seek to fix some market failures in capital markets. If, say, SMEs have trouble accessing capital markets, some support might be necessary to enable them to have access to the financing they need. So not all of the support is bad, but some can be pretty bad, pretty distorting for not only the economies itself, so resource allocation within China between sectors, between capital and labor, and so on. But there's also the question of distortion for others, for third countries. Obviously, the worry I have from a trade angle when I look at these numbers is the contagion effect and countries competing with one another to engage in some kind of race to the bottom, providing a lot of subsidies. The problem with this is that a lot of countries cannot afford to join that race. So we're talking about the big economies like Korea, France, Germany, US, Japan, Taiwan, so on, China. But a lot of countries just do not have the resource to join that race. So they will just drop out of the race, they will lose altogether. And that really points to the need for tougher rules on subsidies and tougher disciplines and transparency over all these measures to make sure that the smaller countries that cannot join that race, do not have the economic and fiscal muscle to join that race, are still not left out altogether and don't end up in a completely distorted world in terms of global competition.
Well, appreciate that, all three of you. And I think this is something that we struggle with as we were working on the report, and it's certainly something that Washington and the rest of the world is a challenge. There is the sort of historical, precedent that and pattern that Réka points out that less developed countries spend more, they face more market failures, and the government needs to intervene. But we are talking about a lot of spending now on very advanced technologies at the leading edge of sectors, not just catch up. In addition, it's just a question of scale. If China was the size of Eritrea, even if it spent 99% of GDP on industrial policy, it probably wouldn't catch much notice globally. But that China is 20-some% of the world's global economy. It's going to have distributional effects one way or the other. And so I think that those two issues collide with each other: the history of how countries develop and the fact that we're dealing with a country the scale of China with its distinctive political economy. Those are just we're between a rock and a hard place on those two big questions. Let me turn to one last thing, and then for folks watching in, you can submit questions via the webpage for this event. So please do that, and we'll try to get to some of your questions. So last thing, which is, what should we do about this? Should we, is this report a green light for Washington, D.C. to use a big stick on China? Or should we, set some kind of cap for countries across the world and say, going above X% of GDP in industrial policy spending is something we should avoid. We note that in 2010, the G20 in their meeting in Seoul that year tried to negotiate a cap for current account surpluses around 3 or 4%. The idea being that we're not going to tell countries how to limit that current account surplus, which was they were worried about that because it was a potential symptom of protectionism. But however you figure out how to get under that cap's up to you. Maybe we could do that here. Or do we just use this? Do we just try and get everyone to be more transparent and use that transparency, the sunshine, as a potential source of additional discipline? Or do we go even further and say, you know what, countries at different historical periods spend different amounts. We ought not to have disciplines on this. It's just something, let a 100 schools of thought contend approach to this. So let me get the panel's views on that. Let's just start with Jehan, then we'll go to Réka and then Yao Yang, and then we will open up to the audience for questions from them.
So in terms of what to do about this, I'd say there's three solutions, at least three solutions that are not mutually excludable. So you can do all three, a mixture of all three, or either of the three, depending on your inclinations. I guess the first is getting countries around the table to negotiate better disciplines. So it might sound wishful thinking. I don't know what's each person's personal view on chances of a WTO outcome, but obviously the first possible solution would be to get countries around the table and agree on some kind of subsidy ceasefire with some better rules to better frame and discipline the kind of subsidies countries can do and the kinds of subsidies they cannot do. So better rules of the road. Like I said, different people might have different views about the feasibility of this in the current context, but it's definitely one option. Second one is strengthening your trade defense mechanisms. So having better trade defense of things like countervailing duties, anti-dumping duties, and so on. A lot of countries right now are actually doing this as we speak, not just the US, but the EU and many others, strengthening the range of tools they have to counter some of the effect of subsidies. And then the third solution is to introduce subsidies yourself to counter other subsidies, which has the obvious implication that we end up in a subsidy race, like I said earlier. So all three are possibilities. All three are being used by different governments at different points in time. And I think we're seeing a bit of all three at the moment. And all three have different, I guess, chances of success depending on your own personal assessment.
Yeah.
So I agree with many of the things that Jehan said. The one thing I would add is, so, you know, again, at the risk of sounding naive or utopistic, I would also very much welcome a situation in where we could get the different partners at the same table. And the only thing that I would add is that before sort of thinking about how to sort of discipline the rules of the game, I would welcome and encourage a discussion about the desirability of industrial policy in different contexts. I very much agree with what Jehan said, that there are good forms of industrial policy and there are very destructive forms of industrial policy. At best, it's wasteful. At worst, it does lead to this subsidy race that leaves everyone worse off. And frankly, again, echoing something that Jehan said, poorer countries simply can't afford to do this. And so, you know, I think one very understandable blind spot of this report is that it does not speak to the experience of poor countries who are at an even lower level of development and who frankly don't have the fiscal or administrative capacity to spend in this type of way. So in a nutshell, my first step would be a more nuanced discussion about the desirability of industrial policy in various contexts. Many people believe that in tackling climate change, the government has a role to play and industrial policy is an important toolkit. Many people believe that at low levels of development, industrial policy and the government have a role to play. If we talked about these sorts of things around the negotiating table, I believe that countries could come to an agreement to discipline the bad types of industrial policy that are destructive and that hurt everyone at the end of the day, and the ones that would promote economic prosperity around the world.
Thank you. Yao Yang?
First of all, to answer your question about whether the U.S. government should use your report to scale up the sanctions on China, my answer definitely is no, right? Because as Réka said, every country is doing this particularly the same, right? It's just that China does it much more. So your analogy with current account surplus is a good one. You know, United States didn't say that China shouldn't have any current account surplus. It's just the magnitude, right? 4% of GDP or below, that's good enough. So that probably should be the direction of the negotiation. I want to follow up on Jehan and Réka's discussion about the desirability of industrial policy. I mean, when we come to the international stage, probably there are two issues that we have to consider. First of all, of course, there is a competition factor out there. If China spends a huge amount of money on subsidies, then US, Europe probably will have to follow up. That's probably what has been happening over the last decade, right? So there is a competition out there. But then we have also need to think about the other side. That is, when countries spends on industrial policy, it creates a new technology, new knowledge, right, that can have positive externalities, right? And in some specific areas, like in climate change, Réka just mentioned, China's investment into solar power, into alternative energy, and also EVs, eventually are going to benefit the whole world. Right? China actually creates a huge amount of technologies in solar power and the EVs. And I believe other countries will benefit, although most of the technology are going to be patented. But still, other countries can learn from China's practice. So I don't know. I think this is a quite academic issue. We have to do some research on this, right? What is the spillover effect when one country spends money on industrial policy?
Let me turn now to Gerard and see if you've got any reactions to these questions about what this all means and policy significance, since you're with me and Ilaria sitting in Washington, D.C., and we're going to certainly be asked, what should we do? We've been given some advice by our panelists about what we should do and what we should not do. And I'm curious what your reactions are.
I think in DC, there's still an ambivalence about industrial policy. So we are probably about to attempt it with semiconductors with the CHIPS Act, right? So I think, if we'd had this discussion, say 5, maybe 10 years ago, it would be in favor of what you were initially suggesting, Scott, which is like, maybe this is something we should try to cap. I think it's less clear now. There's less of a consensus that this is something that's necessarily bad, which then gets to the point that everyone was making, that we really have to get into the specifics of these policies, what sectors we're going after, what are the goals. I mean, for example, I totally agree that climate change is something that requires a government response that will almost certainly include industrial policy across major economies. So I think it's ultimately you have to get into the specifics of how anti-competitive, how distortionary are these tools. Our project is fairly neutral on like making value judgments of industrial policy. We are really just trying to quantify data. I think is our key innovation here. But I think that is a necessary part of having the discussion of what is even going on, how big is it? And then you also have to discuss, okay, given these specific tools or goals, however you want to parse it, how do you want to handle that? And I think at a minimum, it's something that the U.S. With its allies needs to discuss. Ideally, we would have a much larger global conversation about that.
I want to bring a little bit of the audience questions in that have been forwarded to me, and I'm going to bring this back to the beginning, which is but to the policy relevance, which is about using transparency and light on this. And if there's good industrial policy and there's lots of experiences of success, why are countries so hesitant to be transparent about their spending? Why not brag and show off how all that spending is being effective and really try to reshape the conversation to say, you know what, the WTO generally looks at industrial policy spending as mostly bad and needs to be limited except in certain circumstances. We're going to run into a problem, I think, even meeting the most minimum policy suggestions of this report, which is transparency. Now, the EU does require its members to report to the European Commission on state aid. Why do you think countries are so hesitant to report more fully on their industrial policy spending? Is there any incentives that we can provide to get them to want to make it so that we don't have to struggle for months on end to do this work? Any folks, any of you, Yao Yang, Réka, Jahan, want to pick this up?
Let me try. I think in China, most of the government's explicit subsidies are actually reported. But of course, some of the data are just scattered around. For example, in the case of EVs, the central government gives subsidies, but local governments give more, right? So if you want to get the whole number, you have to do a research, okay? The difficulty, of course, is those implicit subsidies, like what you calculate subsidized loans. It's very difficult to get, right? And I don't think it's fair to ask individual governments to report that. That's almost impossible, right? Unless you just give a kind of guidance for all countries to report, in a standard way. But that, I think that's very difficult.
Okay. Jahan and Réka, do you think Yaoyang is right that Gerard, Ilaria, and I, and the rest of you have good job security in coming up with data going forward? We can't ask governments to do this.
Well, there's a metaphor I like to use at work, which is it's a bit like doping in sports. So you don't expect athletes to come out saying, "Hey, I've used a substance that is prohibited, or a substance that might be prohibited and is helping me win the race." So you turn to a testing lab to get the answer, right? You test samples and you try to detect in urine or blood whether there's been foul play here. So I don't think you can expect countries to all be very truthful in subsidies. For also one good reason, which is it's very hard to get people to agree in the first place on what is a subsidy. And we've had a good discussion today about SOEs and loans to SOEs and payables to SOEs. And there wasn't like unanimous agreement as to how much we should count that and what really was a subsidy out of all this part of the stack you had. So imagine now the discussion taking place in the WTO in a much more fraught, politically charged setting. And I don't see how countries can agree on what to even disclose in the first place when it comes to those things.
Okay.
So what I would add to this discussion, and this is my speculation, but I sort of building off what Jehan and Gerard were getting at, I think at least 5 to 10 years ago, the broad consensus, I think both in academia and among policymakers, is that industrial policy is probably something that is bad. It should be curtailed, and we shouldn't be doing it. So I think if that is kind of the thinking in the WTO, in the multilateral institutions, in policy circles, then clearly, as Jehan was alluding to, like, countries are going to try to hide it. And what's even more problematic, countries are going to try to do this in a way that becomes increasingly hard to detect. We move away from tariffs to subsidies, to subsidized loans, to informal guidance. And I think, just to reiterate the point about a more nuanced discussion about the desirability of industrial policy, I think if we had a discussion in which we acknowledge that industrial policy is a widely used tool in many countries, and that in some contexts it could be desirable, that would also provide countries with more of an incentive to potentially report some of these things. So I think, there is kind of an incentive here as well, that if we acknowledge the reality on the ground, and if we acknowledge that we are in a world where market failures are going to create a need for industrial policy, from development to climate change to other issues, I think that will also create a much more sort of constructive environment where countries are more willing to disclose what they're doing, and they're going to be less willing to try and hide this in increasingly more difficult ways to detect.
Well, a very good point by you to help us wrap this up, and by everybody. We've come to the end of our time, and so I'm going to have to bring this to a close. I'm going to say that we wish that Italy's spending on infrastructure and industrial policy would be a little bit more successful, as we've lost Ilaria the last few minutes. And so we will give Rome a green light to spend more on its telecom network. And hopefully we'll have her. But Ilaria contributed a lot to the report and to the early part of the conversation. We're sorry we didn't have her the last few minutes. This has been a fascinating discussion. We really appreciate having the feedback from Yaoyang, Jahan, and Réka to the report, touching upon the methodological issues, what it all means, what we should do. Again, as we can tell, we are in the middle of a ongoing long conversation. I think one of the final points I think that comes out of this is that we need to not necessarily analyze this just simply from a lecturing perspective, that there's still a lot to learn about why countries do this, what the effectiveness is, and how it should change. I am quite concerned that we are in a potential race to the bottom, and one in which countries will get less transparent, not more transparent. And so that is a challenge, particularly when a lot of the research shows that although there are lots of successful cases, there's also more often than not failures of industrial policy spending. And while some countries have the ability, like a venture capitalist, to rack up losses with a couple successes, most countries don't. Most countries don't have the ability to just to lose a lot of money, and they don't have the systems in place to spend effectively. And so, as we're trying to figure out what types of disciplines that we put on subsidies and various kinds of industrial policy spending, we're going to need to think more effectively about what is more likely to generate the good outcomes than the worse outcomes if we're going to go down this road much, much further. I want to thank my co-authors, Ilaria and Gerard, for all the work that they have put into the report, as well as our teams in the economics program and the trustee chair, as well as the publications team at CSIS, the folks who helped us host today, to our commentators. Again, thank you for your feedback. To those who offered comments in our workshops and along the way, and to the audience for asking good questions. Sorry we didn't get to all of them today, but this will be an ongoing discussion in the Washington policy community and elsewhere for a long time, and we hope to continue to be a part of that. Wherever you are, wish you a good rest of the day, a good evening, or a good morning. Take care and be well. Cheers.